If you're thinking about investing in real estate, or if you're just trying to buy your first property, today in SERDNA Talk, we're going to talk about the life cycle of a mortgage. Keep in mind that there are two ways of doing things. One is the wrong way, and the second one is the right way. And most of the first-time home buyers do it the wrong way, which is seeing, browsing, or even visiting properties without even being pre-qualified by a mortgage broker. They think they can afford to buy a $500,000 property, when in reality, they can only afford half of that. So today, I will explain to you how the process works from the perspective of a loan officer. First of all, if you're thinking about buying a property, all you have to do is go online and find the best mortgage broker. I suggest that you interview many of them. Do not save with the first one you see, unless you have seen 4, 5, or 6 already, and the first one you saw is the one exceeding your expectations. And if you need help finding the best mortgage broker here in Florida, just let me know. I will introduce you to them. The loan officer should explain to you in great detail how the process works. You will be talking with him about your current debts, your current income. They will check how good or bad is your credit, or if you have any derogatory marks in it, among other things. The loan officer will be asking you for the following documents and plus more, I'm pretty sure. And each case is treated differently. So be ready, because you need to keep in your hands your bank account information, credit information, purchase agreement, proof of employment, proof of income, tax documents, place of residence. If you have readily available all the requested documents, then they will start the pre-qualification process, and hopefully they will be giving you a pre-qualification letter within hours. This pre-qualification letter will say something like, "Congratulations, SIDAC, you have been pre-approved for $450,000 and your monthly payment will be approximately $4,000 per month at 4.2%. Now that you, the buyer, have that letter of pre-qualification in your hands, go find the best realtor to help you with the process of finding a home that matches your criteria and negotiate on your behalf. Once you have found that property, then submit an offer immediately. Do not make the mistake of wanting to see everything that is out there, since that will confuse you and you will be wasting the most precious thing in your life, which is time. If you decided to present an offer and if the seller has accepted it, then your realtor or you must share the executed contract with your lender immediately. Immediately. Now that your lender has your accepted offer in their hands, they will analyze in greater detail the loan approval with the new information. Now, the loan will be sent to underwriting, and if everything seems good to the underwriter, then they will be issuing a new document or pre-approval letter. Do not get confused. The pre-qualification letter is the first step, and that won't guarantee that you're eligible to buy your property yet. The pre-approval letter is the one that you care about. Once the underwriter approves the loan, then they will be sending documents to the title company. And if everything went fine, then the buyer will be going to the title company to sign and close on his property. Let me go back a little bit to explain the purpose of the underwriter. His main function is to determine how much risk is involved in the transaction or purchase. And in order to do that, they will check your credit history. Also, they need to see if you are able to repay the loan and if you have any collateral to repay it. You better have good credit history, because that alone can kill your dream, even if you believe you have the money for the down payment. Now, let's talk about your current job, salary or income, since that is very important as well. Your capacity to repay the loan will be weighed differently if you are an employee versus self-employed. Self-employed are riskier loans. So for how long have you been working for the same company plays a big role, since that will indicate how stable you are. The lender will also be checking your credit depth, and they will evaluate your debt to income ratio. The higher the debt to income, the less likely the buyer will be able to repay the loan. And last but not least, your assets will be taken into account. And the loan to value is something that you need to watch out, since FHA loans are usually riskier for the lender because the buyer is basically buying a property with 3.5%. In simple terms, the higher the loan to value, the riskier the loan. The lower the loan to value, meaning if the buyer makes a 20% down payment, then the risk will be lower. If you have any questions, just subscribe, double tap the bell, and remember to share all my videos with all your friends and family. I have to go. See you soon. Ciao.